a legacy IT hardware company. I mean, the exact same company that likely manufactured that bulky desktop tower sitting on the floor of your childhood bedroom just reported a waiting list for their products that is larger than the GDP of several sovereign nations.
Yeah, it's wild. $51.3 billion.
Right, $51.3 billion. And to be clear, that is not their total revenue. That is just the backlog.
Just the backlog.
It's literally the line of customers standing outside the door, practically begging to hand over their capital, waiting for physical machines that, haven't even been built yet.
It really forces a complete recalibration of how we view infrastructure cycles. I mean, we're watching a company that the market historically priced as this, slow-moving, mature dividend stock.
Yeah, a dinosaur, basically.
Yeah, exactly. And suddenly they post the kind of explosive capacity-constrained metrics you would really only expect from, like, a disruptive sovereign defense contractor during a global arms race.
Welcome to the Deep Dive. Today we have our hands on a piece of source material that maps out the underlying physics of this exact arms race. We are looking at the Q1 2027 earnings conference call from Dell Technologies, dated May 28, 2026.
And our mission here isn't to just, gawk at the top-line beats or parse the standard Wall Street analyst Q&A.
No, definitely not. We're going to extract the actual signals about the artificial intelligence rollout, the severe fractures in global supply chains, and frankly, the rapidly changing architecture of enterprise computing. Because
the underlying story hidden in this transcript really isn't merely about Dell's quarterly execution.
Right.
It is a real-time diagnostic of the physical infrastructure required to power the entire global AI boom. We're looking at the hard constraints of silicon, of power, and thermal management, all playing out right there on a balance sheet.
So to you, the listener, whether you are managing a tech-heavy portfolio and directing enterprise IT strategy, or just intensely curious about the actual physical metal required to keep these large language models from hallucinating, this deep dive will map out the terrain. Okay, let's unpack this.
Let's go.
Before we get into the heavy engineering and the supply chain mechanics, we really have to look at the sheer scale of the headline numbers, because they totally set the context for the behavioral economics we'll be discussing later.
Yeah, the magnitude of the top-line growth is absolutely the necessary starting point.
Okay, so total Q1 revenue hit $43.8 billion.
Which is just staggering.
It's an 88% year-over-year increase. Diluted earnings per share came in at $4.86. That represents a 214% jump.
Over 200%. Wow.
Right. Operating income hit $4.2 billion, which is up 154%. And they generated $4.1 billion in cash from operations in a single quarter.
And they returned a massive chunk of that to shareholders.
Yeah, $2.1 billion returned to shareholders via buybacks. I think it was around 11 million shares repurchased at roughly $147 in dividends.
Unbelievable cash generation.
But look, as someone who tracks market history, when I see an 88% revenue jump in a hardware manufacturing sector, my immediate reflex is to assume this is a pull-forward distortion.
A pandemic hangover kind of thing.
Exactly. Are we simply watching a post-pandemic style hoarding event? Like where a perceived shortage triggers a panic buying spree that effectively just steals revenue from, say, 2028 and 2029?
I mean, that is the logical skeptical position. It really is. The transcript reveals underlying operational mechanics that actively contradict that pull-forward thesis.
Okay, how so?
Well, to understand why this isn't just a temporal distortion, we have to isolate the operating expense metric. Management reported that OPEX dropped 610 basis points to 8.4% of total revenue.
Wait, hold on. A 610 basis point contraction in OPEX during an 88% top-line revenue expansion.
Yes.
I'm trying to visualize the unit economics there. It implies they essentially double the size of the business without adding any proportional friction to the corporate machine.
What's fascinating here is that it illustrates massive operational leverage.
Okay.
In a standard linear hardware cycle, if you want to sell 88% more servers, you generally need to scale your logistics, your sales force, your administrative overhead proportionally.
Right, you hire more people, buy more trucks.
Exactly. Your margins remain relatively static, you just have a larger pie. But what Dell demonstrated here is a structural shift in their product mix.
Meaning they aren't just selling more of the same stuff.
Right. They aren't just pushing more low-margin boxes. They are selling highly customized, densely packed AI server racks and proprietary storage systems that command a massive premium.
Ah, I see.
They push tens of billions of dollars of high-margin revenue through an existing corporate framework.
So, it's less like a traditional manufacturer scaling up their assembly lines and more like, say, the power grid developers of the 1920s.
Oh, that's an interesting way to look at it.
Like the physical lines were already run to the factories. But suddenly, the factories realized they needed massive amounts of high voltage industrial current to run new automated machinery rather than just, basic electricity for light bulbs.
Yeah.
Dell is just pushing a much higher value current through the exact same grid.
A highly accurate comparison, yeah. And this shifts the narrative from a temporary panic buy to a sustained high-margin architectural upgrade. The fundamental profitability profile of the hardware they're selling has evolved.
Well, let's dig into that specific hardware then. Because the Infrastructure Solutions Group, the ISG division handling all the heavy data center metal, is really where the gravity of this report lies.
Absolutely. The ISG numbers were historic.
ISG revenue hit a record $29 billion, up 181%. But inside that ISG number is the AI server data.
The real fuel for the fire.
Yeah. They booked $24.4 billion in new AI orders, recognized $16.1 billion as revenue, and exited with that staggering $51.3 billion backlog we mentioned at the start.
And we really should note the composition of the buyers driving that backlog. The transcript details that the AI customer base expanded to over 5,000 customers.
5,000.
That is a 50% increase in just 6 months.
Which completely kills the narrative that AI infrastructure is still isolated to the mega cap hyperscalers, your Microsofts, Googles, and Metas.
Precisely. It's way beyond them now. They are selling to neoclouds.
Wait, neoclouds, what exactly is that?
Yeah, so neoclouds are these specialized regional cloud providers focused entirely on AI workloads.
Oh, interesting.
Right. And they're also selling to sovereign entities building nationalized AI grids, as well as just standard global enterprise businesses. The adoption curve has breached the walls of Silicon Valley research labs and is now essentially a mandatory capital expenditure for traditional industries.
When I look at the dynamic between NVIDIA and Dell here, I keep returning to an aviation analogy.
Okay, I like analogies. Lay it on me.
So NVIDIA designs the GPU, right? The jet engine. And it's an absolute marvel of modern engineering. But if you are an airline, say a massive healthcare conglomerate or a global bank, you don't go out and just buy a pallet of jet engines.
Right, because a jet engine sitting on the tarmac is useless to you.
Exactly. You need the fuselage, the avionics, the landing gear, the pilot interfaces. You need the entire airplane assembled, tested, certified, and rolled onto the runway. When management talks about the Dell AI factory, it sounds to me like they're acting as the final assembly plant for these enterprise airlines.
That analogy perfectly captures the friction point in enterprise AI adoption right now. Integrating these new platforms like the NVIDIA Verubin rack-scale architecture or the GB300 systems they mentioned in the call, it is not a plug-and-play IT exercise.
No, I imagine not.
The physics of the data center have fundamentally changed.
Well, let's talk about those physics because the transcript explicitly called out a transition to direct liquid cooling architectures. Yeah. Now, I know GPUs run hot, but why has the thermal management become such a severe bottleneck that a company needs to hire Dell just to keep the servers from melting?
Okay, so consider the thermal design power of a traditional CPU server.
Right.
A standard legacy processor might draw, say, 150 to 250 watts of power.
Okay, pretty standard.
Right. Data centers for the last 20 years were built with forced air HVAC systems designed to cool racks operating within those thermal limits. Now, you introduce a modern AI GPU, which can draw upwards of 1,000 watts per chip.
1,000 watts, just for one chip.
For one chip. And you pack 8 of them into a single server and dozens of those servers into a single rack. The power density is orders of magnitude higher.
So a standard data center air conditioner is effectively just blowing warm air on a furnace.
Worse, actually. The air itself literally cannot carry the heat away fast enough, regardless of how cold it is. The physical properties of air are insufficient for that level of thermal transfer. You must pump liquid coolant, often these proprietary refrigerants or specialized water loops, directly over the silicon heat sinks.
That sounds incredibly complex.
It is. Furthermore, these GPUs must communicate with each other with near zero latency, which requires incredibly dense networking topologies. If an enterprise IT director tries to retrofit an existing data center for this on their own, they will fail.
They just don't have the background for it.
Exactly. They lack the structural engineering, the fluid dynamics expertise, and the specialized networking talent.
Which explains the massive service differentiator highlighted in the transcript. Dell isn't just shipping the boxes. They are engineering the rack, integrating the liquid cooling loops, configuring the networking, testing it all in their own factory, and then wheeling it onto the customer's data center floor ready to execute code.
That integration layer is an incredibly deep moat. I mean, you can secure all the NVIDIA silicon allocation you want, but without the deployment engineering, the chips are dead weight.
Yeah, a very expensive paperweight.
Exactly. This is why the enterprise is willing to accept whatever margin Dell builds into the price. The cost of failing to deploy the AI cluster is far, far greater than the premium paid for the integration services.
This makes the AI server boom intuitively understandable, right? Highly complex, expensive infrastructure replacing legacy hardware. But that brings us to the most counterintuitive revelation in this entire earnings call.
The traditional compute surge.
Yes. If every IT budget on the planet is being cannibalized to fund these multi-million-dollar GPU clusters, why on earth is traditional old-school compute exploding at the exact same time?
It's such a great question because traditional server and networking revenue hit $8.5 billion, which is a 92% year-over-year increase.
92% for old technology.
Right. And it was accompanied by an 8% rise in storage, largely driven by Dell's proprietary intellectual property.
Right, the PowerMax, PowerStore, and PowerScale systems. And the call noted that demand for these traditional 18th generation servers, which, to be fair, offer massive consolidation and data reduction, remained well ahead of supply across every geographic region. But again, if GPUs are the future, why are companies panic buying traditional CPUs?
If we connect this to the bigger picture, it reveals a massive blind spot in how the market currently visualizes artificial intelligence. During the call, management repeatedly deployed the term agentic AI.
Okay, let's dissect agentic AI. Because up to this point, the prevailing mental model for AI has been a chatbot, a sophisticated digital oracle.
Exactly.
You type a prompt, it generates a response, and then it just stops and waits for you to take action.
Right. The first wave of enterprise AI was purely advisory. It could draft an email, write a snippet of Python, or summarize a PDF, but a human operator was still required to copy, paste, execute, and monitor the results.
You still had to do the heavy lifting.
Exactly. Agentic AI removes the human bottleneck. We are moving from AI as an advisor to AI as an active, autonomous operator. An agent doesn't just write the Python code. It provisions a server, tests the code, debugs the errors, pushes it to production, and then monitors the network traffic.
So it's software that actually does the work, rather than just suggesting how the work might be done.
Yes. And this is where the physical hardware architecture comes back into play. GPUs are fundamentally designed for parallel processing. They are brilliant at doing the deep, simultaneous mathematical calculations required to understand language or recognize patterns.
But they have a weakness.
A big one. They are notoriously terrible at sequential logic, input-output management, and maintaining the state of an application.
So if you just unleash a cluster of GPUs to run a business process, they wouldn't even know how to interact with the existing digital infrastructure. They need, like, a harness.
Harness is the perfect word. Traditional CPUs are designed for rapid sequential logic and system management. The CPU acts as the executive assistant to the GPU's creative genius.
Well, I like that.
When an autonomous AI agent begins executing tasks, the traditional CPU is the component that manages the memory allocation, handles the network requests, and interfaces with the legacy databases. The transcript explicitly stated that the CPU is in the loop in every decision that an agent makes.
So it's a completely symbiotic relationship. You can't scale the brilliant autonomous AI agents without proportionally scaling the administrative CPU infrastructure required to actually manage their actions.
Exactly. And that completely explains the 92% surge in traditional servers. But, the agentic AI thesis also explains the sudden strain on enterprise storage architectures.
Yeah, management made a point to say that unstructured data feeds the beast. I assume they mean that AI doesn't learn from neatly formatted Excel spreadsheets, right? It learns from the messy, chaotic reality of corporate data.
Right. Raw audio logs, video telemetry, millions of unformatted PDF contracts, scattered email archives.
The sheer density of unstructured data required to train and continuously update an enterprise AI model must be staggering.
It is. The transcript highlighted their PowerStore Elite architecture, boasting 1.5 million IOPS.
Wait, IOPS? Input-output operations per second.
Yes.
To put that in perspective, why does a system need to move data at 1.5 million operations per second?
Because a GPU cluster is an incredibly expensive asset to leave sitting idle.
Okay, that makes sense. Time is literally money.
Exactly. If your storage array is slow, your multi-million-dollar GPU is forced to wait milliseconds, which, in compute terms, is an absolute eternity for the next batch of data to arrive. High IOPS storage architectures are required to keep the GPU fully fed and operating at maximum utilization.
Wow.
But there is a second, even more critical reason for the storage boom, and it ties directly back to agentic AI.
Audit trails.
Precisely. If a company allows an autonomous software agent to execute financial trades, modify live software code, or automatically approve supply chain contracts, the legal and compliance departments require a bulletproof, immutable record of every single action that agent takes.
They need the receipts. I mean, you can't just tell a regulator, well, the AI did it and we don't really know why.
Exactly. You need an exascale storage footprint just to maintain the telemetry logs, the decision trees, and the state history of your autonomous agents.
So this is why traditional infrastructure is surging. The AI revolution isn't replacing legacy architecture, it is resting on top of it. It's creating an exponentially larger demand for foundational compute and storage.
Couldn't have said it better.
Which naturally leads us to the supply side of the equation. If nations, neoclouds, and traditional enterprises all suddenly require entirely new liquid-cooled GPU clusters, paired with massive CPU harnesses, paired with exascale storage arrays, I mean, there simply isn't enough physical material on the planet to build it all instantly.
No, there isn't. We are witnessing the collision between practically infinite digital demand and the hard physical limitations of global manufacturing.
The transcript was incredibly blunt about this, too. Management stated that demand continues to exceed supply, and they fully expect to exit the current fiscal year with a meaningful backlog.
Yeah, they didn't mince words.
They specifically pinpointed 4 major bottlenecks in the supply chain: DRAM, NAND, advanced CPUs, and high-capacity hard drives.
We are seeing acute constraints across the entire memory and storage spectrum right now. The fabrication plants that produce short-term system memory and solid-state flash storage simply cannot spin up new fabrication lines fast enough. And advanced microprocessors are totally bottlenecked at the packaging level.
And the result of this scarcity is a highly inflationary environment. Dell noted they're being forced to execute daily repricing of their systems just to keep pace with the fluctuating cost of raw materials.
Daily repricing, let that sink in.
Seriously. When I read through the Q&A section of the transcript, the behavior of the enterprise buyers in this inflationary environment immediately reminded me of the hyperinflated real estate markets we saw a few years ago.
Oh, the psychology of scarcity overriding the discipline of cost control.
Exactly. When a buyer shows up to an open house and sees 20 other motivated buyers, logic goes completely out the window. They start waiving the home inspection, they waive the financing contingencies.
They just throw money at it.
They lock into blind bidding wars just to secure the asset, because the fear of being priced out of the neighborhood forever heavily outweighs the financial risk of overpaying today.
Yeah.
The transcript explicitly notes that enterprise customers are signing multi-year agreements for AI infrastructure without even knowing what the final price will be. They are prioritizing access to the silicon over the cost of the silicon.
And we really must analyze the corporate logic behind that panic.
Why are they doing it?
For a major enterprise, missing the AI transition is viewed as an existential extinction-level event.
Wow.
If their primary competitor deploys an autonomous agentic AI that reduces their operating costs by 30% and they are stuck waiting 18 months for a server rack, they will be rendered completely uncompetitive.
So they go bankrupt.
Basically, yeah. The hardware price premium is just a rounding error compared to the risk of bankruptcy. Therefore, securing a place in the hardware queue is the paramount directive from the board of directors on down.
But Dell isn't just a passive observer of this buyer psychology, are they? They have a mechanism to exploit it. I want to look closely at Dell Financial Services, or DFS.
This is a huge part of the strategy.
The call noted that DFS is experiencing double-digit origination growth. Why are massive corporations taking out loans from the hardware vendor to buy servers?
This is one of the most critical structural insights in the transcript. Dell acts as a shadow bank for IT infrastructure.
A shadow bank.
Right. In a normal macroeconomic environment, an IT director operates within a strict annual capital expenditure budget. They buy equipment linearly as they need it. But in a hyperinflationary scarcity environment, buying linearly guarantees you will be priced out or supply constrained next year.
So they use Dell's balance sheet to hoard the equipment today.
Precisely. They use DFS to originate a massive multi-year loan, effectively pulling forward 3 years of infrastructure procurement into a single quarter. They completely bypass their own internal treasury constraints.
That is wild.
The IT director secures the physical metal in their data center today, locks in their AI capability, and spreads the inflationary cost over a multi-year financing agreement.
It's literally an infrastructure hoarding bubble fueled by vendor financing.
The risk there is fascinating, though. If the enterprise overestimates the immediate utility of the AI, they are sitting on massive piles of rapidly depreciating silicon that they bought on credit.
True.
But for Dell, it's a brilliant way to lock in long-term revenue and interest income while solidifying market share.
It creates an incredibly sticky, deeply integrated customer base. Once a customer finances a massive proprietary storage array and server cluster through Dell, the switching costs to a competitor become prohibitively high. All right, so we have established the absolute chaos happening in the data center. But there is another piece of the computing ecosystem that directly interacts with the end user. If the data center is where the AI agent lives, the personal computer is how the human worker actually interacts with it.
Yes, the edge devices.
And the numbers reported for the Client Solutions Group, the PC division, are frankly baffling.
Baffling because they defy the consensus macroeconomic narrative.
Yes, the consensus narrative is that the PC market is dead, or at least severely dormant. During the 2020 and 2021 pandemic lockdowns, essentially every corporation, school, and consumer on Earth was forced to buy a new laptop to facilitate remote work.
Right, the great pull forward.
The conventional wisdom for the last few years has been that the global market is completely saturated. No one needs a new laptop because they just bought one. Yet Dell reported CSG revenue of $14.6 billion, up 17%.
Incredible numbers.
Commercial PCs hit $13 billion, up 18%. And the operating margins on these devices hit an incredibly high 8%, dropping $1.2 billion in operating income to the bottom line. How is this even possible in a saturated market?
Management detailed a convergence of 3 distinct catalysts, basically a perfect storm that is forcing a massive global refresh cycle despite the recent pandemic boom.
Okay, what's the first one?
The first catalyst is the simplest time. The devices purchased in the early days of remote work are now crossing the 4-year mark.
And a 4-year-old laptop in an enterprise environment is basically a paperweight.
Exactly. The battery degradation is severe, the moving parts are failing, and the processing power is struggling to keep up with modern bloatware.
Makes sense.
The natural depreciation cycle dictates that these fleets must be rotated out. But that natural cycle is being dramatically accelerated by the second catalyst, the Microsoft Windows 11 mandate.
Right. Microsoft is sunsetting support for Windows 10. And this isn't just a software update you can click ignore on.
No, it is a hard security mandate. When an operating system loses official support, it stops receiving critical security patches. No enterprise chief information security officer will ever allow thousands of vulnerable machines to connect to their corporate network.
They'd lose their job instantly.
Exactly. Upgrading to Windows 11 often requires specific hardware features, like a trusted platform module or TPM 2.0, which older laptops simply may lack. Therefore, corporations are being forced into a massive hardware upgrade cycle purely to maintain basic cybersecurity compliance.
But time and Microsoft mandates alone don't fully explain the 8% operating margin. Those drivers would normally lead to companies buying the cheapest compliant fleet laptops they can find.
Right, the race to the bottom.
Yeah. The margin expansion tells me they are buying highly premium, expensive machines. Which brings us to the third catalyst.
The push to run artificial intelligence at the edge.
Now, I understand why a company needs a massive, centralized GPU cluster in the cloud to train a foundational AI model. But why does the actual work, the financial analyst, the HR manager, the developer, need AI capabilities running locally on their individual laptop?
Because of the inherent limitations and risks of the cloud-centric model, primarily latency, bandwidth, and intellectual property security.
Okay, break that down for me.
The transcript heavily features their new Dell Pro Max systems, which are specifically engineered with neural processing units, or NPUs.
An NPU is essentially a miniature AI brain designed specifically for local inference tasks, right?
Exactly. It handles AI workloads far more efficiently than a standard CPU without draining the laptop's battery in 30 minutes. Consider the security implications for a major pharmaceutical company or a quantitative hedge fund. If their employees are using agentic AI to analyze proprietary chemical compounds or algorithmic trading models, they absolutely cannot have that highly classified data leaving their local network, traveling across the public internet, being processed in a centralized public cloud, and then returning to the device.
Right, the attack surface is too massive. And the risk of data leakage into the public model's training set is just a nightmare for the legal department.
Therefore, the enterprise strategy is shifting to edge AI. You run smaller, highly specialized local language models directly on the employee's machine. The data never leaves the laptop.
That solves a security issue.
Yes, but to execute these complex models locally, a standard fleet laptop with 8 gigabytes of RAM and a basic processor will crash instantly. The machine requires massive memory bandwidth, advanced thermals, and an NPU.
So IT departments are forced to buy top-tier premium mobile workstations for their standard workforce, completely destroying the old budget models for employee hardware.
And these premium devices carry significantly higher gross margins. But, the transcript also revealed a tactical maneuver by management regarding the pricing of these PCs that heavily influenced that 8% operating margin.
Oh, the delayed pricing strategy.
Yeah.
I found this to be a fascinating piece of corporate game theory. Can you walk through exactly what Dell did while component costs were rising?
We established earlier that global shortages in memory and solid-state storage are driving up the raw material costs for building PCs.
Right.
In a standard scenario, a manufacturer would immediately pass those costs onto the consumer by raising retail prices to protect their profit margins.
Which is what everyone else did.
Dell's competitors largely did exactly that. But Dell took a calculated risk. They intentionally absorbed the inflationary component costs and held their PC prices steady.
Why intentionally eat the margin compression? That sounds dangerous.
To weaponize their balance sheet for market share acquisition. By maintaining artificially low prices relative to the market, they became incredibly attractive to massive enterprise buyers looking to execute high-volume fleet upgrades. They captured a disproportionate share of the total available market volume.
They prioritized market share over short-term margin.
Yes. But here's the brilliance of the execution. In hardware manufacturing, volume solves many problems. By pushing massive volume through their logistics and supply chains, they created secondary operational efficiencies.
Oh, I see.
Once they had secured the market share and locked in the enterprise contracts, they subsequently raised their prices to reflect the new cost environment. But because they now had significantly higher total volume, their operating expenses as a percentage of revenue remained suppressed.
They captured the market, maintained the volume, and still achieved record profitability.
It's an aggressive, highly effective capitalization on their competitors' margin sensitivity, and it perfectly demonstrates why evaluating a company purely on top-line revenue misses the underlying strategic maneuvering.
Okay, so we've analyzed the historical data of the quarter. The 88% revenue explosion, the $51.3 billion AI server backlog, the traditional server boom driven by agentic AI, and the edge computing PC renaissance. Now, we really must look forward. What did management project for the remainder of fiscal year 2027?
The forward guidance provided to Wall Street is arguably more disruptive than the historical results. It indicates that management believes the constraints on their growth are entirely physical, not demand-driven.
Let me lay out the numbers they committed to. For Q2, the quarter immediately following this report, they guided for total revenue between $44 billion and $45 billion.
Wow.
That represents roughly 50% year-over-year growth. They expect the Infrastructure Solutions Group to be up 75%, bolstered by an anticipated $15.5 billion in AI server revenue in that single quarter alone.
That Q2 number sets a remarkably high floor, but it is the full-year revision that demands serious analysis.
Yeah, after only 90 days into their fiscal year, management raised their full-year FY27 revenue guidance by an astonishing $27 billion.
A $27 billion upward revision. I mean, that is not an incremental adjustment. That is the addition of an entire Fortune 500 company's worth of revenue to their existing projections.
It's insane. They now expect full-year revenue to land between $165 billion and $169 billion. They raised their full-year AI server revenue expectation by $10 billion to $60 billion, a 2.4 times year-over-year increase. Traditional servers are guided up over 60%. And full-year earnings per share is pegged at $17.90.
Just massive raises across the board.
From a corporate governance perspective, making a $27 billion revision this early in the year requires a pipeline that is virtually immune to macroeconomic shocks. If they miss that new, highly elevated target later in the year, the market will punish them severely.
Which makes their framing of this guidance so compelling. Throughout the call, management repeatedly deployed the phrase appropriate prudence.
It's almost comical.
Yeah.
They added $27 billion to the target and claimed they were being prudent. How does a CFO justify that framing?
Well, because they were responding to analysts who were looking at the $51.3 billion backlog and asking essentially, why aren't you raising the guide by $50 billion?
Yeah.
Management had to clarify that their forward-looking demand pipeline is currently running at multiples of their existing backlog.
So they are tracking potentially hundreds of billions of dollars in enterprise demand.
Exactly. But they cannot legally or ethically guide Wall Street revenue based on unconstrained demand. They can only guide based on what they possess, the physical capacity to manufacture, integrate, and ship within the fiscal year. Their prudence is not a reflection of softening customer appetite. It is an explicit acknowledgement of the severe limitations of the global semiconductor supply chain. They are guiding based on their guaranteed silicon allocations from NVIDIA, AMD, and memory fabricators, not their sales pipeline.
There was another fascinating nuance in the guidance regarding profitability. They noted that their margin rate expansion, specifically the metric they call XAI, meaning the business excluding the AI server mix, is actually projecting higher than it did 90 days ago.
Yeah, that surprised some people.
I thought the AI servers were the golden goose. Why is the non-AI business suddenly getting more profitable?
This brings us back to the storage mechanics we discussed earlier. The AI servers themselves are incredibly expensive, and much of that cost is the NVIDIA GPU, which Dell has to purchase.
Right, they don't make the chip.
So the gross margin on the actual AI hardware box isn't necessarily software-like. However, the AI server acts as a Trojan horse for the rest of Dell's portfolio.
Because you can't buy the server without buying the storage to feed it.
Correct. When a customer buys a $50 million AI cluster, they must also purchase massive arrays of unstructured storage to hold the training data and audit logs. And unlike the GPUs, Dell manufactures that storage the PowerMax and PowerStore systems using their own proprietary intellectual property.
And proprietary IP always carries massive gross margins because you aren't paying a middleman for the core technology.
Exactly. The low to mid-margin AI servers drag incredibly high-margin proprietary storage, networking gear, and deployment services through the door behind them. As the total volume of AI servers shipped increases, the proportional mix of highly profitable storage increases alongside it, driving a structural upward lift in the margin profile of the entire enterprise. It is a highly leveraged ecosystem sale.
Let's synthesize all of this raw data, the psychological buyer behavior, and the physical constraints into a cohesive takeaway. We arrive at the bottom line. Based strictly on the empirical data within this earnings transcript, how should an analyst or an IT strategist view the trajectory of this company and the broader hardware sector?
Synthesizing the evidence rigorously, the conclusion is overwhelmingly bullish, but it requires a very specific caveat.
Let's start with the bull case.
The demand signal is entirely de-risked. The debate over whether generative AI is a transient fad or a structural macroeconomic shift is over.
It's settled.
The presence of 5,000 discrete enterprise customers actively spending billions of dollars on physical deployment proves that the technology has crossed the chasm from experimental proof of concept to mandatory operational infrastructure. Demand will not be the constraint on growth for the foreseeable future.
But the caveat is the physical reality, the bear case.
Yes. The bear case is entirely tethered to the fragility of global supply chains. The ultimate ceiling on Dell's valuation and revenue growth is not customer willingness to pay. It is the physical extraction of silicon from the earth, the complex photolithography required to etch circuits, and the geographic concentration of memory fabricators in geopolitically sensitive regions.
Right.
If a shock hits the semiconductor supply chain, the revenue growth will instantly hit a brick wall, regardless of how many multi-year contracts customers want to sign.
So for you, the listener, the actionable insight is to shift focus away from purely evaluating the software models. Yes, the large language models are the face of the revolution, but the companies that control the physical picks and shovels layer The companies that master the thermal dynamics, the proprietary high IOPS storage, and the complex factory integration, they are the ones capturing guaranteed high margin revenue today.
That's exactly right.
They act as the physical tool booth. You simply cannot run the sophisticated software without paying the toll to the hardware integrator.
It is the unavoidable physical bottleneck of the digital era.
Which brings us to the close of our analysis. We started by dismantling the myth of the sleepy legacy hardware company, watching it leverage deep engineering expertise to capture an 88% revenue surge.
Yeah, quite the turnaround.
We visualized a $51.3 billion backlog of AI servers, constrained not by capital, but by liquid cooling and silicon allocation. We explored how the desperate hoarding of hardware via Dell Financial Services is pulling future revenue into the present. And we documented the surprising renaissance of traditional servers and edge computing PCs, driven by the absolute necessity to harness, manage, and secure agentic AI.
It really paints a picture of a deeply interconnected ecosystem where every leap in autonomous software capabilities dictates a massive, unavoidable upgrade in the physical architecture of the global economy.
And that leads me to a final, somewhat philosophical question derived directly from the mechanics we've discussed today.
This raises an important question.
We have established that the architecture of computing is shifting from AI as a passive advisor to agentic AI as an active, autonomous operator.
Software that independently executes complex business workflows.
Right. And we noted that this autonomy requires vast arrays of traditional servers and exascale storage specifically to track, manage, and record what these agents are doing, to maintain the audit trails and the receipts.
Yes.
So the question for you to ponder is this. As we rapidly approach a future where autonomous software models are writing their own production code, executing high-frequency financial trades, negotiating supply chain logistics, and running our critical infrastructure completely independent of human input, who actually holds the ultimate power?
That's the real question.
Is the true power held by the brilliant autonomous AI software itself? Or is the ultimate authority held by the companies that own the physical metal, the silicon, the liquid cooling loops, and the exascale hard drives that control the environment and keep the immutable receipts of the AI's actions?
The entity that controls the physical environment and the historical record ultimately controls the digital mind.
A fascinating architectural reality to mull over. Thank you for joining us on this deep dive. Keep looking beneath the surface, keep questioning the consensus narrative, and we will see you next time.